Everyone will need to consider capital gains at some point in their life, whether it's from selling shares, an investment property, some cryptocurrency, or collectibles. At its very basic form, capital gain is when you sell something for more than you bought it for. Say I bought Qantas at $3 during COVID and have now sold it for $6. I have made a capital gain of $3, which I then have to declare and pay my marginal tax rate on come tax time. Now, if I had held that asset for 12 months or more, I get a 50% discount on top of that. So instead of declaring a $3 gain, I instead declare only $1.50 and pay my marginal tax rate on that. So if you've sold those shares for a loss, you cannot use your capital loss to offset your income. Instead, you need to keep carrying that forward until you have made a capital gain in which you can offset. But as I alluded to earlier, it's not quite that simple, as your cost base can make up a few components. With shares and crypto, you also have your buy and sells. So you've got your brokerage that needs to be taken into account. And what that does is it effectively increases your cost base, which means that it's reducing your capital gain. But your investment property is where it gets very complex, as each year you claim some depreciation on that asset because, why not negatively gear? But that's coming back to bite you as it's reducing your cost base. So we have the cost of the property, the costs involved in purchasing the property, the cost of improvements made, and legal fees. They all add to your cost base. But then we have less the decline in value and capital works deductions that you've been making each year and claiming against your income tax. Because of this, when you have a rental property, it's important to plan when you sell it due to those tax consequences. If you'd like to learn more, make sure you book in for a meeting. Thank you.